Happy Saturday, everyone. Thank you for attending another weekly market analysis. I hope you're all doing well despite this unbelievable markets that we're having, but it is, I call it is an education. So it's good to go through these things. Um, as always, we look at the economy. I'm going to emphasize this week more on the markets. Like to look at things from the big picture. And you're hearing a lot about the TV pundits, and then you hear some of the blogs and talking about, we are really oversold, that the markets are really overshot. There's a lot of negativity out there, and this is time to get back in. So I thought let's spend a little more time this week and really dive in to the markets to see how true that is. As always, we have some subject of the emerging markets. As I mentioned, the lesson of the week, I'm going to mostly emphasize on analyzing where we stand with the markets. And we have a couple ideas and talk about the trade of the week. It could have helped ourselves maybe do a few trades by observing the charts. And then as always, we have a screen of the week. So with that in mind, let's dive into economy. And again, as always, the economy is all about interest rates and the strength of our economy. There's more and more talks about recession. So basically, one thing we noticed, the initial jobless claims came in. Now that went a little wrong way. So we are seeing a little bit of a pick up compared, let's say, to 2019. We are a little higher, although continuing jobless claims are still doing well. So that's a good thing. As far as one thing I was happy to see is the TSA checkpoint. So it tells you, people have started traveling, flying. A lot of airlines are now consolidating their flights. Although my daughter came back from London, she said, she came with Virgin Atlantic, and she said, my God, there were many seats empty, and she had the whole row to herself, which is maybe coming from London here. That was the case. And so again, we want to watch these global commercial flights. Obviously, the thing is, it's made a lot of universities and colleges, they are closing and ready for the summertime. We've got the high schools and school systems. They are finishing a couple of weeks. So the traveling season starts. So we want to pay attention to that. And it looks like more and more people will be driving on the road and perhaps even not traveling by flight. So, but we will see that, and we'll see how much effect that will have on the gasoline prices. So we'll speak about that once we talk about the crude oil. So one big thing last week was, besides the housing, it was emphasis was on the retail sales. And obviously we had our retail earnings, and you noticed that this problems with the big chains such as Walmart and Target and Kohl's and Ross stores. And the only one really had a better earning was survived in a sense shortly. I mean, in a short time frame, it was the TJ Maxx. Other than that, I mean, Target had the worst, I think since 1980s probably, or ever, 24.8% down. And, people are having second thoughts. So that was, didn't bode well. But this, having said that, the retail sales actually came, and they grew, up 0.9% in April, and they revised the March numbers. Actually, I think it was like 1.1 or 1.4%, and 9 out of the 13 major sales categories increase in April. So we had the autos, non-store retailers, the restaurants and bars. So there was, with the opening of the economy, the services, coming back. And again, with the auto even though still slow, but they had more sales, and that was a good news. And obviously, as I mentioned, with the restaurants and the bars as well. So the other thing we have to look at is the building materials, gas station sales. They all rose 1.2% in April, and they're up 8.9% from a year ago and up 26.6% from February 2020. So those are the good things, the good news. Now, the bad news is um, inflation has been the major component of all these increases. And what I mean by that, let's say we talk about retail sales, which they were up about 8.2%. Remember, the inflation was 8.3%. What that means is a lot of people are going shopping in a way, I mean, the numbers are up, but the shopping, the quantity is not there, is what they are buying is more expensive. So basically, it is not the activity, it's the price. So it's the inflation is the one which is actually is affecting the increase in the retails. So that's, we have to take that into consideration. And again, we want to watch this. We want to make sure we are not keeping pace with the inflation. And one of the things is about the gas. For instance, the spending at gas stations fell because less people decided to use gasoline, but it was a rebound because of the gas prices were up. So we want to take a look at, again, we want to make sure we look at the whole piece rather than just bits and pieces and saying, oh, retail sales are up, that was great. So basically, we want to make sure we understand the whole thing. This coming week, again, we have a lot of central bankers talking, but the main thing I want to pay attention is on Wednesday at 11 a.m. Pacific Coast time, is that FOMC meeting minutes. Now, if you recall last month when it came out, I mean, it was almost like having an FOMC day. So pay attention to that on Wednesday. On Thursday, we have the preliminary GDP quarter over quarter. And then on Friday, we have the PCE, the personal consumption expenditure, which is similar to CPI. But again, the Fed pays attention to this. And that's coming at 5:30 a.m. on Friday. So let's pay attention to that. And with what happened this week, if you notice, the yields actually did go down. These are talking about the 10-year yields and the 30-year. And basically, the main reason was, once we look at the markets, we shall see that it was the flight to safety. And it looks like that the bonds, the treasuries, the fixed income is the place right now where the money started going back. We had the money going to like Swiss franc, Japanese yen. So basically, that's one of the reasons the yield did go down, because of nervousness in the markets. So you see that flattening, the inverted curve, first of all, the yield curve has reversed, and we're still getting flattened from the 5-year to 30-year. So there's still that concern as compared to where we were exactly a year ago. And one thing I want, again, pay attention is the spread between the high yield and corporate yield. So that's, spread is getting wider. So we want to watch that. All right, let's talk about markets. As always, we start with sentiment, and this is on Wednesday, the AAII, and we haven't really moved much. You see the negativity, the fear is still there. I like to look at the spread. So the spread is about 24.4. The bulls are still in minority, and again, they have moved up a little bit from April 27. But when we look at the spread, it used to be 7.5, and we've been just floating around in the 20s. That tells you that there is that concern. Now, the question is, and I said it before, does it show in the markets? And that's what, again, in the lesson of the week, I think we will dive in. Is this really a time to go bargain hunting? Or this is not hasn't ended yet. So that's what we'll discuss. The same thing happened with the CNN fear and greed. We are in extreme fear now, but we can see, although we've had been around here, last week we were in extreme fear, and basically a month ago we were at extreme fear. So, but this is the performance. So that just by itself doesn't mean anything. So, but that shows us concerns. But as I mentioned before, like institutions, a lot of them are actually been hedging themselves. So that's one of the reasons I think you see that there's still a little complacency in a sense because they know they are hedged. And we are back in neutral with the Citigroup, kind of euphoria. So for the week we had, again, we're getting used to this. The Dow Jones, which has been actually better than the other one, still is, but that was a big down week for Dow Jones. We're down to 31,000 area. We're down 2.91%. And NASDAQ, again, was the biggest loser. We went through the 13,000, went through the 12,000, which was an important round number. Now we are at 11,354, and S&P 500 passed, that 4,000 last long. We went down to 38 plus and bounced back, which we will discuss that toward the end of Friday, down 3%. The commodities, on the other hand, all of them were up. Gold was up because it hit the support 1.91%. Copper was up, more of a China story, and then crude oil was kind of flat, but still an uptrend. You can see that the Dow Jones is performing better than the others. It's only down 15% from the high of January 4th. S&P is almost in a bear zone. So we are in a correction, but it's getting very close. We hit it actually one time, and we lost over 20%. We are at 18.66, and the NASDAQ is down in a fair market at 28.28%. And look at oil, is only down 8% and up 48%. Now, for the week, the whole market's average of the US markets, they were down 2.85%, and they're down 9.2% year over year. Now, as always, I like to separate the markets from the size point of view, and also from growth and value. I highlighted this, and I just want to show that the large cap value has been, when we look at year over year, has lost the least amount. So they have been the leaders at this moment. They're only down 4.74, and then you can see the mid cap value is down 9.07%. So that's as far as the style, and then the size. We can see that the small cap still down compared to the large cap. So large cap is, as a whole, so the size is only down 8% year over year, but the small caps are down 18%. So just a little analysis on that. So let's go to the charts. We have looked at where we were, in mid-February, the low of the February. We had talked about going from 4,800 down to 4,100. Well, you can see we had a fight in the battle, I should say, and then the bulls lost. And now that low of February has become the resistance. So last week we talked about it. It will be more visible when we look at the Bollinger Bands and see how we tried to come back. And when you look at the 8 and 21 day, the 21 day just produced the resistance. And this was amazing Friday, I should say. And we will discuss it in the trading, because I'm going to look at in the 5 minutes what happened. And when you look at the expected move, but you have to remember, it was the option expiration. So option expiration Friday is usually volatile. There's a lot of rolling, filling, closing positions. So that was one of the reasons. We will discuss it more. And it's interesting that we were up, actually, it shows 4.25. but the cash market was up 0.75. And then you look at what a day it was, you would think, oh, what a boring day it was, but it was amazing how when you look at from the high to low, it was just it was a big swing, almost this is 142 points. So this is what I want to pay attention. And we've talked about last week, I talked about capitulation. And the question is, the markets have been going down. Was Friday a reversal day? We did go below, we have gone below the close of this day, and which was on Thursday, we closed it. And on Friday, we went the low of the 52 weeks. So we hit the all-time 52 weeks low, but we bounced back. Is there a fear? And looking, although we have some, above average volume, and I've said it before, in the capitulation, there's a fear. You see the huge volume, there's that fear, and it doesn't look like it yet. So we will discuss it more, but that's just one of the observations. Maybe look at the Bollinger Bands. You can see, and you will see a common theme with all these Bollinger Bands. So I've said it in the past, but it's worth reviewing it, is what happens when you're embedded, and let's say we touch the Bollinger Band, and once we get to oversold, so when we come out, and oversold is only, you don't have to have both, only one of them. As soon as it crosses the 20, that means now we are oversold and it's moving up. Generally, when we come back from the Bollinger Band and we go to oversold or perhaps overbought the other side, right? The markets like to go and hit or kiss their next pivot point, next target, which in this situation, the closest one was the 18-day moving average. So we did that. And guess what happened? As soon as we hit that 18-day moving average, and that was on Tuesday, and you could see the reversal happen and the momentum turned down. So now if we would have momentum would have continued, and let's say we went up and passed that 50 and we passed this 18-day, then generally, then it will continue to go to the next target. In our situation would have been the Bollinger Band. If you look 100-day moving average was below that, then it would be the 100-day moving average. So the markets like to, again, fill their mission and go and hit their objectives. So just keep this in mind. We go from embedded to oversold. From the Bollinger Band, we like to go to the next target. You can see the MACD still, the momentum is down. So you can see Bollinger Bands, are they opening? So is this a bottom, or the day that we had on Friday, or was it just a reaction to the options? So Monday would be a crucial day. So I want to pay attention to Monday because a new wave of options will come in. So this was a monthly option expiration. So let's pay attention to that. So I want to look at the weekly on the SPX. And as you can see, last week we talked about, we were sitting right at 100-week moving average. Well, we violated that and we broke below that, and that doesn't bode well. So if this week is a down week, that's, that tells us the selling hasn't ended and this will continue. The only savior that we might have for next week is generally because of the Memorial Weekend coming up. Generally, before the holidays, the 2 days before, you might have a bounce. Markets like to be positive. People start leaving early. They like to just be in a good mood. So that's the only savior. But if we continue being below that 100-week moving average, the same thing that we had with Russell, the same thing we had with NASDAQ, that doesn't bode well for the markets. So be aware of that. Now, we see how NASDAQ has been, on a downtrend. And again, the similar idea, we went to oversold, went and hit our target of 18 days, and we sold off. And as you can see, MACD is going down. When we look at the Russell, the same thing. We were oversold. We go hit 18-day, we got rejected. Now, this week, again, we're going to look at the weekly, but this is the Dow Jones that done better than the other indices. But again, we go hit that 18-day, right? We touched it, and that was a high, and then we got rejected. And you see again, Bollinger Bands are opening, and we are going back to oversold. And if we stay here for 3 days, that will be embedded. Now, on a weekly, this is similar to SPX, the SP Cash, and we just broke below 100-week moving average. Now, why is it important to me, and I want to emphasize that, is because we want to go back and see the last time we broke below that 100-week moving average was actually during the pandemic at March. We tried, you can see it was flat, and we had it a few times in May of 2 years ago, but we didn't stay, and we've been, this back and forth. So I want to pay attention. This is important. This 100-week had not been violated in 2 years. So the transportation is another one. Again, similar idea. We were sitting on the support. We go hit that 18-day, and then we reverse. Now, there's a doji here, and I will explain is that important or not. Is that a reversal candlestick? Now, on a weekly, you see even transportation, we violated the 100-week moving average. It's a similar story as the other indices. So this is a crucial week, because if we finish below that 100-week, then there's that pressure is there, and it will continue. What happened with VIX? Now, this is a puzzle, right? We're talking about, okay, 52 weeks low in all these indices, and yet VIX just broke under its 18-day moving average. What gives? What is happening? And you see it's been pretty choppy, although we still, above the 29, above the 25, above the 100-day moving average. And we actually in contango, believe it or not, we used to be in backwardation. So the question is, again, there is a lot of hedging going on, and that has reduced, and there is a little bit of complacency, and that's what concerns me at this time, regardless of the emotional. Remember, saying like American Association of Individual Investors, it is what it is. It's a survey, and the survey just tells us that whether they're going to be they think 6 months, market's going to go down, go up, let's say this, same, and basically they tell you something, but that 100% is not what they're actually doing it. So you see, as a matter of fact, the volatility itself of the Bollinger Bands is narrowing too. So we want to pay attention to that. Again, as long as we stay above the 100-day moving average, that means the markets are in trouble. But just seeing that we are below that 18-day, and we tried to break above, and of course there was a reversal in the markets. That was the reason VIX went down. And here we are at 107 for the volatility of VIX, really haven't gone down anywhere. And basically, even that skew is one of the lowest it's been. So it does tell me, again, there's not a lot of panic going on. As far as the 10-year yield we talked about, again, looks like the markets are looking for safety, security. So that's what the money has been going to the 10-year notes. And that's why we had nicely came down after touching the upper Bollinger Band. We came down. We were overbought at this moment, touched this, went below, and then now you're going to touch the lower edge. So let's see if we can hold. Again, if we have the volatile markets, you will see that. The 10-year note is the opposite of the 10-year yield. You see we broke above and now above the 18-day, and now we are at the overbought zone. So, and we're touching the Bollinger Band. So I have been mentioning for the last couple of weeks that watch for these Bollinger Bands. They're really narrowing. So they're coiling, but that means also right now it's a quiet time. So, but let's see what happens. On a weekly basis, though, that was interesting. Although we are still embedded, so that's important to know. So anytime, even if we go hit the 18-day, as long as you're embedded, which sometimes when you're embedded and you are not oversold, then you will not touch the next target. Once we get oversold, then we will touch it. Now, what happens is if we continue being embedded, then there's a good chance that we will not touch and we will have a reversal. MACD is trying, but it's not there yet. The only thing is we are still at the support, long-term support that we've had. So you can see 3 weeks ago, 3 days ago, 3 weeks ago, 3 weeks ago, we hit it and we bounced back. So it looks like this number is holding. And on the 30-year bond, very similar to 10-year note. Financials, same problem. We talked about just watch financials. If financials go, technology was first to go, financials go. That will take the S&P with it, and that's what's been happening. The dollar, again, what happened with the dollar? That has been the safe haven, but now the Bollinger Bands are narrowing, so that doesn't mean that dollar is going to keep going down. No, I think we're going to have some stability. Dollar still going to be strong compared to other currencies, although the MACD is crossing, but the trend is up. But it looks like the money is looking for other avenues, and this obviously helped the commodities such as copper and gold and platinum. When we look at gold, this is what happened. Again, you look at dollar and then gold, and we went right to our support, and the same story. We were embedded, oversold, came back and almost hit that 18-day moving average as well as resistance, but we got rejected on Friday. So basically a big move happened on Thursday. So, and by the time for our gold trade, it was a little too late. The options open at 6:30. We already had a big move. So it kind of, that's the only problem with the options. And the next day, even though we did go up, almost hit that, because of the extrinsic value, the theta, the options did not hit all the targets. So that's for our gold trade. When we look at the situation with the silver, you see the same story exactly. We went with that 18-day moving average to resistance and got rejected. And here, when we look at the copper, we can see there was a news last week with a little bit of opening of China. Now, China is a different story because what is happening, and we'll discuss a little bit in emerging markets. I don't think they're going to get away from their COVID zero tolerance. So that's going to be there. They have been talking, about Shanghai. The grocery stores are opening. So there was some photo shooting and a photo for maybe propaganda that, oh, we are opening. So that bode well for the for copper. But Chinese properties are in trouble. So it's a balancing act. But regardless of that, as you can see again, we were embedded, went to oversold, went and hit that 18-day, and now we are just right parked there, and Bollinger Bands are narrowing. So we want to watch that for copper. Now, Bitcoin has been just sitting on that 30,000 area, and I think this is going to be for a while. The moving average, 18 days coming down, so eventually they're going to meet, and then but we are in an oversold position, so we shall see if the Bollinger Bands are going to narrow. So I would be, I'm not playing this. It's just maybe it is um, at this time it's consolidating. So we'll see. There's a need for catalysts for all of these. And right now, again, the dollar is the one. Euro had a nice run and then came back down. So it's not euro. And the crude oil, its own world, although it was only up 0.1%, still above its 18-day moving average. Just went slightly too overbought. So we'll see what happens on Monday. And energy, just the best sector of all the sectors, and up 40+%. So they're above their 18-day moving average. So let's dive in. This was really, again, interesting week. Please pay attention to these expected moves, which is amazing how things happen. Now, when we look at S&P, you see how we've been floating right around the lower edge of expected move. So what happened? A big sell-off. And we went to the 52-week low. This is on SPY cash at 38.10. We bounced almost 100 points and we finished at 39.01, which is amazing. So what happened? We've talked about gamma squeeze, but the other thing is we have to remember the market makers, they have to be delta neutral. And after this selling, what happened on Friday, again, with the options being all filled and trying to closing the positions, right around this area, what they were turning to delta negative, they were all delta negative. So they closed all their positions to become delta neutral. So now we had this positiveness. So delta positive came into the picture. And that's why if you look at the charts on a 5 minutes, the last hour was tremendous, about, as I said, about 100 points reversal, because the buying pressure came because a lot of short positions were already being closed. One of the important things you have to remember, and that's a technique we use, the strategies, once we went below of this, what happened? We had all these stop losses were getting hit one after another. So they got hit, they cleaned them up, and then they reversed it. So, and that's why that delta negative, it was not needed anymore, and it had to be delta neutral. I hope that's helpful. And guess where we went? We went almost to the edge of the lower edge. It's more the same with the NASDAQ, the QQQ. You could see how that reacted, very similar to the S&P cash. And then on the Russell 2000, it happened that we actually hit that. We went to that expected move, and as long as we stayed in the middle, there was no need to do. We bounced back. So that was within the expected move. It was the Dow which really suffered the most last week. And as far as big sell-off, again, we hit the 52-week low, but we bounced back. So again, that delta play. Now, as far as the bonds, as I mentioned, there was flight to safety, safe haven. And what do the bonds do? The bonds go right to the upper edge of expected move and stopped right there. Now, gold trade was a little difficult, as I mentioned. So it was, I didn't buy a lot of contracts because, look, we were right on Thursday, we hit the upper edge of the expected move, and it respected that on Friday. So there was not a lot of move to make. And silver, on the other hand, it had gone above its expected move. And what did they do on Friday? They came back and closed right on the edge of expected move. The same thing with financials. They went outside the expected move, but ended up coming inside. And energy just spent the time, even though Wednesday it went up and hit the 52 weeks high. All right. Okay. So let's discuss the emerging markets, where we stand with them. Obviously, we still have a war going on in Europe. We still have the China closing. We still have the food crisis really in the different markets. We have elections coming in a Colombia, and basically we had an election in South Korea a couple of weeks ago. So there's a lot going on, and of course this inflation on top of everything else. So as you can see, again, this is as of Wednesday's numbers. So for up to Wednesday, the markets were doing good. So a lot of markets were in green, that's blue. And when we look at the year to date, again, the only economy in Europe, basically the major one, is Britain, which is in positive. Turkey is still up 28.9%, and Indonesia is up 3.2%. Singapore 3.3, Argentina is still up, Brazil up, and Saudi Arabia. And basically, what you could see, there are, other than that, everything else is, you can see it's down, and that's as of Wednesday. And when we look at the GDPs and we look at the consumer price index, you want to pay attention. You see that China and Japan are the only really very low ones compared even to the previous year. That's why you see Japan is still devaluing, or they are okay with the lower interest rates and lower yen. So, but then, this is 9% for April. And, this Britain came with the 40-year high for their inflation, and Greece is up 10.2% compared to 6.6. So majority of these countries, except like, let's say, Italy, they are much higher than a year ago. And of course, you go to Turkey, it's at 70%, and Argentina at 58.5, and Brazil is at 12.1, and Egypt at 13.1. So let's pay attention to that. So some of the headlines last week, it was Thursday when China banks, they cut their 5-year loan prime rate by 15 basis point, which has been most since 2019 interest rate revamp. And the whole idea is, again, I mentioned about the properties, they're trying to stimulate things. They have a weak mortgage demand. So basically they reduced the rates from 4.6 to 4.45. So they are trying and stimulate, but in the meantime, I don't think they're going to get away. I mean, they're going to go away and with their get away from their zero tolerance COVID tolerance. The other big news was the UK consumer confidence. It fell to its lowest level since 1970s. In 1970s, remember, we had this high unemployment and high inflation there, and retail sales actually jumped because of alcohol and tobacco spending, and that doesn't bode well, actually. China increased its energy imports from Russia. We've talked about that in April. And although, again, the COVID lockdown has slowed the domestic, but I mentioned it before, we talk about Western countries, and if you recall, Russia stopped their exports to Poland and Bulgaria, and they said that now you have to pay us in rubles. And this week they did the same thing to Finland. They said, if you don't, no rubles, no gas. So but again, the alternative is China and India. So they are still continuing that. The other thing was that Romania's central bank, they actually raised their rates by 3.75%. So again, because they're expecting higher inflation, and that's what it showed on Friday. This was interesting, just because, again, the Russian markets are in our mind. So Russian central bank is going to lift their short selling ban on June 1st. And this is coming from the leading broker. We talked about some of the winners, what's happening around the globe. And you see that Nigeria is, which you didn't have it, but Nigeria is number one, up 26% year to date. Jordan, Abu Dhabi, Saudi Arabia, Brazil, Chile, Kuwait, Doha Stock Exchanges, Qatar, Zambia, and Bahrain. And you can see that a common theme in all of these is really commodities, especially crude oil. So that's who's been helping them. So when we talk about emerging markets, that's why I want to separate the consumers versus the producers. So there is two themes going on, and that's what it shows in the markets. The other thing was, with this correction in Apple, we can see what has happened. Saudi Arabian, Aramco, Saudi Arabian oil company, has become the largest company in the globe, passing Apple. And you see, well, there's a good reasons. Apple is down 20%, and oil companies up 35%. I just want to finish this by just looking at some of the best banks around the globe, and we go by regions. So I thought, well, let's see individual countries, what are some of their best banks if you ever traveled or you want to deal with them. These are in Asia Pacific, for instance. It starts from Afghanistan and all the way to Vietnam. Basically, a country like Iran, or you don't see Iran or Iraq because they are pretty closed in a way. So, or North Korea is not here. But you see the rest, some of the top banks, and some of them are actually public. So you want to pay attention to that. As far as Latin America, this is the list of them in all those countries in Latin America, from Argentina to Venezuela. And again, some of these, I know for a fact that they are public companies. They're actually United States. They have ADRs, so pay attention to that. And then I want to move to North America. I didn't put it here. According to the survey, the best bank is the TD, Dominion in Canada, and Bank of America in the United States. So that's it. That's all they have. But as far as I thought, let's look at the regional banks and look at some of the strongest banks. And basically, this is what we have. The last one is, you know how I feel about Africa, and I think there's so much potential there. So every week I like to bring something about that. And Angola being actually for many years, people didn't know, but Angola became actually an oil producer. They do have mining, and we're looking at their debt. It actually, when we compare to a lot of other emerging markets around the globe, Angola's debt has been going down. And of course, we've mentioned about commodities and especially crude oil. So that has been a positive thing, and just a food for thought in the future. So there are countries that they are, have a positive moves. And also there is a presence of China in Angola, a big presence, and they've been helping them with their refinery and all the other things. So that's another element. So, but it was interesting, we all talking about developing countries, what is happening, and some of these and developed countries, they're going the other way. Now here we have emerging countries, especially in Africa, taking care of their debt. All right, so I want to spend a little time on this one, the lessons. So, and I want to start with this. This is a video I did on January 8th, and it was our market analysis. That was actually lesson of the week. And if you have a chance to go to January 8th, because I don't want to play it here, I'll let you watch it. It's on the 57:21 minute. And basically, what I want to tell you at that time, I remember we were coming, markets were January 4 hit the, some of them hit all-time high. NASDAQ had hit it in November. And we were looking, Russell did, but NASDAQ, Dow Jones, all of them, it was beginning of actually that week we were talking about. And what I want to tell you is I want to go back in the history and give you a little history lesson saying that, the last time we had a similar thing when Fed actually came out and said they're going to increase the rates, but also they mentioned they're going to reduce their balance sheets. which is we talk about quantitative tightening, and that they mentioned that they're going to do. So I want to go back and see when was the last time we did that, and that was in October of 2018. September they mentioned, October they started doing it. So what I said, please watch for that, because last time we did that, Chairman Powell had just actually been appointed. And when this thing happened, and I remember in December he had a speech, we dropped from announcement or the high of that market, we dropped over 20%. So basically, this is on S&P. So be aware it could happen. Now, you see that we did go up because, again, pressure from President Trump and other things, that they reversed the whole decision and they actually decided to reduce all the rates that had increased. So the markets reacted, and obviously we had a nice 2019. But 2018 was a negative year. So if you had paid attention to this, you had a little bit of itinerary, knowing that you've got to be very cautious. And in the past year, we've been talking about the value investing, talking about the fundamental understanding of the markets. Because markets, as long as there's liquidity, yes, they can go up, and there was the opening of the economy and all that. But everything has a price and eventually has a value. And once we extend that, then it goes the other way, it gets ugly. So we did the same thing. The NASDAQ had come down about 25%. So just want to pay attention to these things. I know maybe I just talk and then I pass by, but this is again, January 8th. So I want to follow up with that, and going back again to investor psychology and look at the cycle to see where are we now, and are we there? Are we in a panic? Do we have the capitulation? And this is where we want to be if you want to start looking at the reversal. So again, I have not seen the capitulation, although I see it on the sentiment. So we want to look at the sentiment. We want to look at the charts and also the action of the markets, but also we want to pay attention to the fundamentals. So this is what we are seeing right now. And there's a lot of talk that the PE ratios are down. Some of them are down lowest they've been in 5 years. Some of them obviously lower than 2 years. We look at NVIDIA and Netflix, and then we look at Kellogg, a lot of food companies. They have higher PE than technology companies. So what I would recommend for you is I would be patient, but I will start having my watch list and look at the valuation. And what you have to think about is the catalyst. What will be the catalyst for the markets to reverse? And where is it going to come from? So far, obviously, we're talking about the Fed. Is the Fed going to stop raising interest rates? Remember, we have June coming. So we have the FOMC meeting, the minutes coming on Wednesday. It doesn't look like the Fed is ready. Actually, Powell has been more hawkish than ever. What is happening with the commodities and inflation? Is it going to go lower? What would be the catalyst for that? What is happening in Europe? With is Russia just going to stop and say, well, you know what, we are done? And basically, these are the questions. And of course, we have the closing in China. And so those could be the questions you have to ask before you completely jump in and say, well, we are ready to buy. So that's one thing I want to mention. But I also want to have your watch list ready, but I'm not sure we are there yet, but I think we are getting close. Now, one of the things we want to pay attention is look at all these sectors, and the only thing has been positive, you see over 48%, 7%, is energy. Everything else is down. Utilities defensive, basically flat, but everything else is actually down. Now, in a bull market, what we want to see usually, well, of course, we want the technology to lead us, the innovation, the hope and future. So we want to look for that rather than, being down so much. So the other thing we want to look at, I mentioned about, um, the, the internals. I mentioned about sentiment. Right now, this is, if I look at on a daily basis, the number of S&P stocks which are below their 200-day moving average, or above, I'm sorry, above their 200-day moving average is about 26%. So that means out of 500 is about 130 of them. Now, on a daily, this is the lowest we've had in a year. But remember, in 2020, we went to below, I think it was about 8% or so. So we are not there yet. We are one of the lowest we've seen. You see, we are very close to that 2018. This is a 10-year chart. So you see, anytime we are really overextended, then yes, we have a bounce, we have a bounce, we have a bounce. Now, the bounces came from, again, this was reversal of quantitative easing. This was quantitative easing. The question is, will we have quantitative easing and more money coming in? This one, obviously, it was not only the monetary ease, but there was a fiscal ease as well. So let's take a look at the 50-day moving average, see how many of the stocks are above their 50, and you see only 14%. Again, we are getting there. So what we will not see is a reversal, and we want to make sure that trend continues. So for instance, right here, right here. But again, every one of them, they were interest rate related. From the charting point of view, from technical analysis point of view, what I did a Fibonacci extension. So I went from the high of January when we hit the highest, went to the lowest first, and then the next highest. And I want to see the extension where we will hit. So the 100% came at the 39.30 or somewhere around there. But it tells you, where they're like 138%, and it looks like somewhere around 3,700 could be our next target. If we break that, it will be 3,600. Some people may say 3,400. Now, if you reverse that, then that's good news, and it also gives you targets like about 4,200. So I want to look at, again, from the sentiment point of view. Now, the dangerous part, when you could see that things are not, they don't bode well, you could see when we started going below our standard line, and then trend line, then inside the cloud, and now we've broken below the cloud, and this is on a weekly basis. So our lagging line is just inside the cloud, so that's still neutral. But once we go below this cloud, then all the bets are off. So just I want to look at from Ichimoku point of view, from Fibonacci extension. So just another food for thought. Also, I want to look at our crossing, the Hall crossing, our 20-day or bar moving average. So it goes from, this is my workspace, goes 5 minutes, 30 minutes, 60 minutes. I don't want to pay attention to these. They're very short term, but these are the long-term ones. So you can see at the Hall, we actually, that was a heads up on SPX that we reversed, went below the Hall bar here, and we actually had gone here. That was a warning right there. But on a monthly, we haven't crossed it, but we have broken below the 20-month moving average. The question is, remember, this is month, so the month is not over. So you don't look at it at, you have to take it as a face value. This is still May. So it could reverse, and we could bounce from this 4,133 point. So let's pay attention to that. But it's the weekly concern. So on the weekly, we did cross it right around here. So what happens, we came back and kissed that 20-week moving average, and then we just broke down. So that's one thing, the slope is still down on a haul. So unless it comes back and maybe haul flattens and goes up, so that's still not positive. Now, one of the problems we run into, and all of us do, psychological, is the fear of missing out. We want to be early. We say, well, why should I, for instance, buy it when it reverses here? Well, I could have bought it here. The problem is, it could actually go a lot more down. When we had the 2000, 2001, when we had the, obviously the internet or the bubble, the NASDAQ was down 20%, and then it kept going, and we ended up going down another 50%. So things can go down. So just be a little patient. Don't rush. That's, again, we might miss opportunities, but I think we also will miss the anxiety as well, just if we don't have that confirmation. So, and on a daily basis, last week we talked about, we broke above the haul, but then we just obviously reversed. So once this crosses this, that might be a good idea to go long, or at least gradually start accumulating. That's on a daily. I like to look at the weekly the most if I'm going to be a long-term investor. Now you could see that on a 30 minutes, for instance, on Friday, that was like 3 days before, on Wednesday. What happened was we had that cross, so you could have shorted the market. We tried to cross it, we failed. So that was telling you, you could have shorted and stayed with it. And then this was a huge move, as I mentioned. It's on 30 minutes, 60 minutes, and look at what happened in 5 minutes. As I mentioned, it was more of a, again, the delta neutral, and you can see how we were close to the expected move. The other thing I want to take a look at, this is from Investor Business Daily, and one of the ways you could see if you're topping, if you're on the bottom, is that the NYSE, this is for the S&P 500, the breadth. Where is the breadth? So you see the breadth of the markets were going up, but the breadth was going down, and we're still going down. So basically what we want to see, we want some stability, and we want the breadth leading us. And right now we're just getting lower lows, and we have a little bounce. So we want to pay attention. As I mentioned, we also want a big sell-off, a flush, to make sure it cleans. And NASDAQ, that would have given you definitely a big heads up. Look at this. We were the highs here, but look at the breadth. The breadth was telling you we're still going down. So that was a sign. And what happens is, now, if we make higher high in our breadth and lower low on the price, then that tells you the soldiers are ready. Right now, the big caps, it looks like, I think Wall Street Journal came out with this, like the big caps are responsible for like 50% of the losses. But you see that breadth is also a big responsible. So we want to watch this as well. So let's discuss the fundamental side of things, because we are hearing that the PE ratio is about 18. It is below the 5-year average. We have not seen this in 5 years, so let's pay attention to that. I like to look at the Shiller PE, which takes into consideration a 10-year average with inflation into consideration. So this goes back, you can tell me, it's like 1870. So it takes the Great Depression, we have the 1987 Black Monday, we have obviously the financial crisis, the internet bubble. So I don't see much of a huge, undervaluation. I mean, you can see, look at the 1980s where we were, 2009 where we were. We are nowhere close. So the mean is 1694, median is 1587. And the question is, we could, our right around here, our justification for the valuations or the P expansion was because of the really low interest rates. Of course, interest rates still low. But the question is, with the higher interest rates, what will happen to the valuation, and especially with the inflation? So I'm not sure, even from fundamental point of view, we're still there. So I would be, again, I will be selective, have some companies, but again, the markets lead the stocks. So it is important to know that when things go down 90, they go down, 90% of the stocks will go down. Hopefully you're lucky you have the 10% one. And you see a lot of them are like commodity related, for instance, those have been doing well. When we look at actually the price to sales ratio, we've come down a lot compared to a year ago. But when you look back and you see from 2001, we are still pretty rich. We are above the 1.66 average. So we also want to pay attention to that. When we look at the price to book value, again, we are 3.87 and the mean is 2.94. So, so from valuation point of view, we still want to be aware of that. Now, granted, like in 2021, we did analysis, we were richly, and the markets kept going up. And again, because we had every month, we had this money coming in. The question is, we don't have that luxury. So the valuations are important now because you don't have that extra fuel. This is real. And I mentioned again in the past, I said, once this is done, hopefully, we will be able to become analysts and see the companies as they are rather than being fueled because of the supply and demand of the money. So it's not about the company, it's about where the money is going. So hopefully that's the light at the end of the tunnel. So the good companies will be rewarded. And if you did your homework, you will be rewarded, and bad companies will be punished. But when you have all this money flooding around, everything just either gets rewarded, and then some of the bad companies go along with the good companies. So kind of differentiate that. The last but not least, I also want to look at the 10-year note. We are at 2.78. So this is the lowest you can see was July of 2020. We were at 0.62%. The highest was September 1981 at 1532. So we want to see that, what is happening compared to where we had been. Again, the rates, basically that doesn't mean end of the world either. So, but, we've come so low that you need to kind of establish and stabilize. So we shall see. I had the 3%, obviously we broke through that. So this is on 10-year note. But the target rate looks like it would be about 2.75 to 3 for the Fed. But who knows? I mean, if there's a recession all of a sudden horizon, things absolutely could change. So I hope that was helpful. So I want to look at, please do not rush into things. Just be very selective, whatever you're doing, and especially with your time horizon. If it's 5 year, then I would gradually go in, find your bargains. Could be sectors, could be, we're looking at, and I will go in our screen of the week. I'm going to look at the cheapest and the most valuable companies on the S&P 500. Maybe you can take a look at them and put it on your itinerary. But as far as the trade of the week, and I mentioned, I said this year will be a trader's dream. And so far, if you're doing trading, although it could be choppy, but I will share one thing that also Matthew brought to my attention too. It's once you know the move, it has been actually sometimes really easy to stay with it. One of the things we did was, I'm missing one screen, and I will tell you, last Friday on May 13th, for instance, we had a gap, and I think I mentioned it, and that gap was filled, I think on Wednesday. So it was a gap up, we closed it. But you see a lot of these, this is an island. So that was actually closed another gap. And you can see we closed this gap with this gap. And then this was our Friday's gap. That was closed. So the gaps have been playing, but it was tremendous move from this to this. That was important. One of the things you want to take a look at, this is a 5 minutes on ES. And I use a 20 and 50 bar moving average. And just want to pay attention what is happening, from the beginning of the day at 5:30, and then how we can take advantage of it. So I use ADX, and you could see right around 6:30 when the markets open, we were below the 50 and we were below that 20 bar moving average. And you could see the ADX is actually up. And what happened, the DMI negative crossed the DMI positive. So that told us that the sellers look like they're in control. And let's say if you would have shorted it or done debit spread or put spread or something like that, every time the market came and hit its 20 bar moving average, got rejected. And we call it stair steps. You can see it's almost like steps. Every single time the ADX is up, so we have the trend. So it did not fail once. We never even went above that. And we stayed with it until almost toward the end of the day, when now, after hours actually, that we flattened and the ADX came down. So pay attention to that. It happened also Friday. On Thursday, it was pretty choppy. So we had, it worked out beginning of the day till like 9:30, 10 o'clock. And after that, it just failed. So the days like that, you want to pay attention to the moving average slope. When moving average is flat, let's say the 20 is getting like it got flat here, that's not a market you want to be in. But when you have a slope, it's just a food for thought. You can see that, hey, this thing has legs and has a trend, has a momentum. So let me play that. One last thing is, I think this was a Greek shipping company, and I had mentioned it was one of our trading ideas of the week. I mentioned about the stock of the week, and last week we talked about Zim, and so I did. The reason I want to share with this, and every week I do. Last week we talked about RCM Tech, and it was up again this week. So I think what I'm going to do in one of our classes, I would like to go and analyze like a Guru's screen. And this was one of the screens about a couple of years ago. It was on valuation. It was a low, not this one, the RCM. It was a low price value company. And obviously it was from 175. We hit 24, I think last week at 23 and 80. Now this one, more of a management. So once we buy it, on Friday morning, once it was up there, I just like to take 25% of my position. It was up 20%. I'm okay with that. We leave 75% for, so we'll see what happens. The idea is, again, it's about making money. I know we want to think about Amazons of the world and Apples and Teslas of the world. You could, but by taking a little bit off each time with money management or position management, it allows you to sleep a little easier at night. So, I still have a few AMC, for instance, shares, but majority are out. But I have nothing to lose, so I can be patient with that if I wanted to. Who knows? All right. Quickly, we go to ETF of the week. I just want to share with you what was the best performing ETF. The markets were down over 3%, and yet the copper miners, the COPX ETF, it was up 6.1%. It has some Canadian companies in there, and the underperformer obviously was the retail, with Target and Walmart and Kohl's and Russ stores. Anyway, they were down 12.4%. And like you can see, the target was actually lower by 31.1%. Bath and Body Works was down 27.4%. And also Invesco Solar TAN was up 5.7%, and another retail was down 11.3%. Talking about the copper, I thought, well, let's review. I think I've talked about this, but one more time. You look at the COPX fund, and it is a $1.7 billion fund, been around since 2010. And that's a pure play. And in different countries, it's interesting. You have Canada, Australia, United Kingdom, and very little in the United States. So some of the big, I mean, tech is a big one. So you have the components of it. I also want to look at the past 10 years. So we can see, well, we've come a long way from 2020. So anytime there's a big correction, copper does excellent when there's a huge drop. So obviously with opening of the economy, the copper has done well. So I don't want to rush in, but so you can see we've come a long way. But it's the next stage. If the things start opening, as I mentioned with China, do we have another leg up? So this is where we stand on a daily basis. I want to look at from Hakinashi. We are right against the moving averages of the 20 and 50. So the MACD just crossed it. So that's good news. And basically we have all these open candles. So right around here would have given you a buy signal right around here once the MACD crossed. But we are against this resistance. So pay attention to that at 38.33. And basically just be aware that we have a resistance. So as far as the stock of the week, it was more on the earnings. So I want you just more of a understanding the earnings. So it's not about recommendation, but maybe we can play, have a position in this. But it was the Deckers Outdoors, which is interesting. Look at what they did. Their fourth quarter, they were up 2.51 versus $1.32. And I've said it that please be aware that there's a earnings whispers. So it's not like what you see is what the market expected. So this 132 was not the whisper, it was what expected, but that's a huge beat. And they rose, the revenues also rose 31.2% to 736 million. The top consensus was like 639. And the guiding for 23 is $17.40 to $18.25. So those are all good. And they have a lot of their brands are doing well. But the Teva brand net sales is the only one which has decreased. So with that in mind, we want to look at where that one stands. So the deck had a really nice Friday. So the earnings came. We are just about to cross, but we have this 50-day moving average, which could create a hurdle for us. So what do we do with that? And then that was on Hakinashi. This is basically on a regular candlesticks. So how are we going to play this? So there's two ways you can approach this. Number one, we can use our gap strategy, right? So the gap is a bracket strategy. So Friday is already done. So we know the close, we know the high and the low. So basically on Monday, you can do two things. You have your bracket. If we open, and let's say if you use 60 minutes, and you're going to be a little more aggressive, you see that, oh, we are above one tick or two tick above the high of this wick at this time, the high of that bracket, then you can go long, and most likely it could go travel up there. And we are above the 50, above the 20 EMA. So, and the MACD most likely will cross, the RSI will go up. So, or if you want to be very conservative, then you can wait till end of the day to make sure it closes and stays above your bracket. Then you have to do it the next day, and you just go in the next day. But your stop loss will be at the low of this bar. So That's what you have to look at as far as your stop loss. Again, you can do debit spread, go with a call spread if you like. The question is, if it goes down, then you will do the opposite. You will short it, or buy, do a put spread on this. So, but this is a gap play, and on the other hand, if you notice that even if it stayed above, the other thing is you can just use the 50-day moving average play and say, well, if it stays 2 candles above that, then you're going to go long. So that's another way of playing it. So that's just something. It's a more of an earning play. The guidance was positive, so that tells you. Remember, this is they've been going down like with the market. So Monday is important. All right, we're almost done. We want to look at our squeeze. It's S&P 100. These are all the companies in a squeeze. And this is just the last one. The last screen that I have is I want to look at a good value in S&P 500. And I have a list of companies that offer low PE, good growth. They have good margins. And also, you can look at some of their balance sheet as well. So let's start with this. And we can use the Finviz, for instance. And all you have to do is look at S&P 500. We go to the valuation, and we rank them based on the PE to growth, so the PEG. And there are a variety of sectors in this arena. So you have some energy. And one of them is, you see Micron shows up, and the PE is low. This is again a supply side of things. It's a semiconductor. By the way, Applied Material last week came with their earnings, and they were beaten. So Micron, I've looked at like $65 area. Looks like an attractive place. So just a food for thought. Since I play Micron, we are at 68, but you see that we don't care much about what is happening. We want to see what is happening next. And forward PEs, you can see very attractive. But all of these, you can see Ford is at 0.06. Price to sales, I value price to sales more than the PE actually. So these are the itinerary you can build. Just put it aside and see. There's American Express here, and even Under Armour, which unfortunately, I believe the CEO is leaving, I think September, October. So that's something that you get your list, then you got to do your qualitative side. You want to look at the management. You want to look at the insiders, look at the options activity. So no rushing, but have this itinerary. The other thing is, of course, we want to look at the financial side. We don't want to buy with a high debt. So I pay attention to the debt to equity, for instance, because again, increasing the servicing interest service, that debt service, that could be a problem. So we want to watch for that. So anyway, you have access to this. I hope it's something you can pay attention to. The other way you could do is you can completely go back and see what are the most expensive pegs around and look at how far they've come. Is it time, maybe if the markets are going to go down, maybe you can start looking at selling some of those, or shorting them. All right. The last but not least, because of the time element, I just still got some earnings coming. So maybe on our Sunday's video, I'll go more in depth. But you see NVIDIA is the biggie on Wednesday. But we still got few in retail and electronics, for instance, Best Buy and Williams-Sonoma, and obviously Costco, big lots. So, and then some technology, Zoom. And anyway, with that in mind, I hope it was helpful. Thank you very much again for your patience, your attention. And we can stop the recording and open up for any questions.